Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending Jan 24, 2020. I'm Preston Brent. Thanks for tuning in. This week's market theme is markets hit a speed bump. Well, looking at the markets this week, everybody finished in the red. I mean, the Dow, S&P, NASDAQ, Russell was in the red. Russell led the way to the downside, 2.2% down. NASDAQ was only down 79 basis points. Both the Dow and the S&P were down more than 1%. Also, volatility popped up 20%. We did see some life involved, but like I was telling our members, the term structure is still in a contango environment. I haven't seen too much fear, even though we closed the week at 14.56. That was up 20.33% from the prior week's close of 12.10. Global markets, everybody was in the red, of course, except for one, the DAX. It was a rare holdout, 37 basis points in the green. But basically, the markets just kind of had a down week on a couple of different issues, which I'll talk about just real quickly. The PE ratio, the twailing. I thought I saw a putty cat. The trailing 12-month PE ratio was at 25.94. The forward 12-month guidance PE is at 19.25. So it's lower by about 25.7%, but we still got elevated valuations and term premium in the market valuations. The S&P annual dividend yield sitting at 1.79%. The 10-year interest rate's 1.68. So that still continues to push money into the equity markets. This market action, most of the week, as I said, in the red from the coronavirus. I think over in China, over 1,000 confirmed cases. I think 41 deaths so far. There've been a couple of confirmed cases here in the U.S. But the immediate reaction, in comparison to terms of the SARS outbreak years ago, which caused the markets back then to drop over 10%, were a lot quicker. Clearly, the current price action moved a little bit to a risk-off environment with this virus outbreak, but it couldn't come at a worse time. You know, the Chinese Lunar New Year, where they take off for a full week. Although I wish the U.S. markets would take off for a week, but I couldn't imagine the opening gap up or down after a week off. But the China Lunar New Year, everybody travels. But like I said, China reacted very quickly to this. What they did, any city with populations over 36 million, they banned from traveling. I mean, they just locked it down, as only China could do. So really, from the market price perspective, markets were looking for a reason anyway, I believe, to take some profits off the table, and maybe wait until we get further economic and Q4 earnings coming up this week. So the coronavirus basically served as one of the catalysts to just kind of take some profits here. But after all, I mean, we've seen really the S&P go over 71 days without a 1% move in either direction. 71 days, guys. That's the longest streak since October 9th, 2018. So we were due for a little bit of volatility, but not as much. And as I said in a prior weekly roundup for you guys, a couple of weeks ago, I think, we saw the short interest and volatility futures fall by 30%. So what that means is when vol goes up, there's less shorts out there to create a short squeeze to really drive volatility even higher. So this reaction where the term structure is still in a contango environment, which is a normalized term structure, just tells me that right now the markets are just kind of using this as a catalyst to just take some profits off the table. Okay. Now, in this risk off market week, I find something really interesting though. The 10-year interest rates, as I said, hit a weekly closing low this week of 1.68%. And the Feds have been adding a lot of liquidity to the balance sheet in a not QE fashion. They've added over $300 billion by buying short-term T-bills, which has a tendency to steepen the yield curve. Okay, so they've been doing this. But what I find most intriguing is that you would think with this additional $300 billion in the balance sheet since last September, that's been the expansion, that over the month of January, the balance sheet's expanded. But it hasn't. It's actually contracted by 25 billion. Now we're going to get more on this from Boom Boom Powell here coming up this Wednesday, because they're having a FOMC policy meeting Tuesday and Wednesday with the press conference at 2:30, the interest rate announcement at 2. I'm not talking about the interest rates because they're not going to raise them. They're not going to lower them. They're going to stay where they are. But why did the balance sheet contract by 25 billion in January? Well, they did this because they're not replacing maturing mortgage-backed securities. So one way, and it's a very crafty, cunning way, I think, and it goes under the radar screen where they can throw money at the short term of the duration curve in the T-bills, right? Steepen the yield, the yield curve by doing this, and yet not renew any of the mortgage-backed securities that regularly come off week to week. So they've actually managed to take 25 billion off the balance sheet. So let's see how he answers some of those questions, which I'm sure are going to come up. Now, also, now that we've gotten phase one of the China trade deal done, you might be thinking that trade issues, pretty much going to be on the back burner, at least until we get through the 2020 silly season of the political elections here in the U.S. But you'd be wrong, because out in Davos last week, which really is a gathering of elites and billionaires and erudites and other idiots running around on this globe, basically they met there, and we saw a salvo being fired by Trump, where France had originally said they were going to come out with import a digital tax on mostly U.S. companies that were operating in France, and Trump said, "No way, we're gonna double 100% tariffs on your cheese and wine." Well, immediately Macron stood down from his initial threat of a digital tax. So at Davos, they came to an agreement. Let's just stand down and talk about it, which is what they did. And also, Trump fired another salvo at the EU and the UK on possible new tariffs if they can't work out a deal on car imports. Of course, Trump couched that statement with, "I think we'll be able to work a deal out, but if not, I'm ready to go." So just when you thought phase one China deal done, not much more in the trade issue, at least for 2020, because phase two is not going to be a 2020 issue, I don't believe, unless China breaks phase one, and then we'll see that back at the table. Then we could have some more issues here with car imports from the EU and the UK, and then with France, and we'll see, because Italy's also on the docket, because Italy threatened the digital tax as well. And I wonder if Trump will throw a import car duty tax on Ferraris coming out of Italy. We'll see. I'm sure he'll find something. So, as I've indicated to our current members, this past year though, 2019, it was really all about PE multiple expansion. All right, it really was not due to earnings growth. I mean, it was really mostly due to interest rate reductions. And as I've told our members, and you guys are learning through my free sessions here on the weekend, you've got to understand the bond market. You've got to understand interest rates to understand the equity market. I don't care if you don't trade or want to trade interest rates or bonds, you got to understand them. Otherwise, you're going to be at a slight disadvantage, right? Earnings in 2019 were very poor, negative year over year. In fact, over 40% of the listed companies last year reported losing money over the 12-month period. That's the highest percentage we've seen since the 1990s leading up to the dot-com bubble. And of the 100 largest companies that reported losses, over 75% saw their share prices move higher. Okay, amazing. Okay, of all the money losing companies, over 41% saw their share prices moving higher. Basically, again, PE multiple expansion and the expectation of earnings growth in 2020. So now that we've got a larger valuation premium laid at the foot of most of these listed companies here in the U.S., the risk to the U.S. markets in 2020, really, we've got to see these earnings come through. If they don't come through this, we're not going to see a PE multiple expansion from the current PE levels of 19.25 from where we are without a concurrent push for earnings growth. I think the year-over-year comparison, the bar is very low. The original forecast was a 10% earnings growth, but as I like to say, and I've seen other people say it too, cut it in half. So let's say we have 5% earnings growth, throw in a dividend yield of 1.79, 1.8%. So you're looking at a 6.8% growth year over year. That would be enough to move the markets up to my target of around 35.75, 35.80 area. All right, so that's kind of what I'm seeing. And speaking of 35.85, let me show you the charts. What I've got here is an Ichimoku chart. It is a daily chart, and you can see we've come up, and every step of the way we've paused at my key fib nodes. And remember, these are fib extensions of prior pivot highs and pivot lows. And these are very strong prior pivot lows, which was December 24th, 2018, and pivot highs that summer. So they're very strong. And Fibonacci, for those of you that don't understand it, take one of our Option Masters courses on it or become a member because we go into a lot of detail on this. But the Ichimoku laid on top of it, Ichimoku really tells you a pretty good story, right? So you can see the hold up here at this first fib expansion. Then you can see we spent at least several weeks there at the next fib mode, and now we've hit this one here and we've run right into a buzzsaw again. So this is our R1 level, our first level of resistance at that PE or at that fib node of 33.38. Now the S&P, it came literally within just a couple of a point or so. I mean, the highs were 33, 37.50. We came within less than 75 basis points of that high right there. And then we pull back just a little bit. Now you see this red line and this blue line. These are moving averages, but they're not the typical moving average that you would think of in most charting indicators. In the Ichimoku, these are built in. These are more of the highest high, highest low divided by 2 kind of moving average. And the look back period is 9 days for the red and 26 days for the blue. So it's a little bit more, in my mind, it incorporates a little bit more volatility into the moving average. So they're very good. And you can see here at no time has the red been below the blue, so it's been indicating mostly a bullish run. And then everybody, when you think of Ichimoku, everybody goes to the cloud, whether it's green or red. And you can see this cloud here is green, so that suggests it's an S1 level or a major support area on this daily. And you can see here that it continues up here like this. So because it's up, that just means we're in a consolidation mode, but the mood is still relatively bullish. And then combining that with the MACD at our settings that we use here in our group, you can see here that there is what we call zero bearish divergence. So that typically means that any pullback is probably going to be bought. And obviously in a pullback, my next level, first support level is going to be that fib node sitting right there. So that's just at a nutshell what I'm seeing here on the Ichimoku with this chart. Right now, another time frame that you guys, if you watch me enough, you'll know that I really like is the 240 minute, because the 240 minute is like an X-ray view of the daily. So now this is a daily. You can see it just looks like it's rocket ship higher. Let's put it on the 240 and look how it changes a pretty good little bit. Once we go in the 240 minute, you can now see that we're seeing weakness. Even though on the daily it doesn't show that much, you can see here we've got this concurrent divergence here, all right, in these beds. Some of them are right here. This would be a poor man's bed, and then this here would be a solid bed here. So without going into detail on what they are, again, members, you know what I'm talking about. So when we come into this, you can see here the constant failure, and now we're into the green cloud here, which is what I call my S1. And then the S1 point here is the same fib node at 3264. Okay, now we did take out a key level, and this key level is roughly right around this area right here. I'm not drawing it exactly straight, but you guys get the idea. It's around 3000. So you can see in this 3000 area, it's a psychological level. It held up and it provides support. So we came down and we blew right through it. Okay, I would expect a possible retest up there, and then if it fails, we're going to come down and we're going to for sure test this area right here. Okay, typically on a Friday, if you have a strong momentum down day on Friday, the momentum continues on Monday, and then it tends to reverse a little bit on Tuesday. Now that's the statistics. I don't know if that's what's going to play out, but we were basically just kind of anticipating this in our user group, as this thing moves through. So you can see here how even on this chart right here, the red moved below the blue, and they're both kind of running sideways right now, which means consolidation. We still are in the green cloud, so that does suggest more bullish activity. But again, you can have things that can change on a short-term basis relatively quick. You can see on this chart using this Ichimoku overlaid with the fibs, you can see if that breaks, we got another ways to go to hit the next level right here, okay? And then you would see the cloud basically go down like that, and then it would turn into a red color, serving as resistance as we try to get back up again. I don't see that happening just yet, but I'm going to watch the play out here. You can see how the red line is paralleling the blue line. So that just is a symbol of basic consolidation right now from an Ichimoku perspective. For those of you that want to learn more about it, there are a lot of good books on it. I've got a good hour and a half or so video in our Option Masters if you want to check that out as well on Ichimoku and how best to use it. So this is just a little bit about what I'm seeing. Now, if we come in and we're going to stay with the Ichimoku now just for a little bit. I want to come over here and let's take a look at NASDAQ. Let's put it back on the daily chart on NASDAQ. And then we'll just stay with this for a minute. Looking at the NASDAQ, well, I got to get it up here, right? Let's put it on a 240 minutes, see if we can get a view here. Okay, so looking at NASDAQ here, you can see it's a lot stronger, but you can see this this succeeding waves of lower highs and lower lows as we move the MACD forward. So that just says be careful here in this move up. Now the NASDAQ has clearly been very strong, all right, and we're just now finding a little bit of support here. So that is just normal in this environment. If I put it on a daily chart, I don't know if I can get a daily picture here. It may just take a little bit of time to draw on the screen. Sometimes it takes more time than others. So let's just get out of that one. And let me come back and let me look at the Russell, because the Russell is another one here. And generally I must have some internet problems today on this thing. Let's put it on the 240, so it tends to be running good. On the Russell, you can see here the Russell was the worst performer for the week, coming down 2.2%. You can see now that we're now getting some red over here in the cloud, which suggests we could get a contra move higher and then roll back over. So we've got to put all of this together to make sure this makes sense for the markets and what I'm seeing. Right now, all I'm seeing is a little bit of a dip. Remember, I define a dip for our members as anything less than a 5% drop from the highs. I define a pullback as anything from 5 to 10%, and then a correction is an official correction, which is 10 to 20, and then a bear market more than 20%. Okay, so these are just kind of the official definitions that I use that makes sense. Okay, now I'm gonna switch gears here and let's go take a look at volatility for a second. And I've got to just bear with me 1 minute here. I am going to stop my screen. I've got to. I think I'm gonna have to. I'm gonna save this right here. Let me just save my eSignal platform. And then I'm going to open it back up again. I think thing froze on me as I was going through some of these charts here. So, but basically what I want to show you is volatility. One of the things I like to look at when markets are going very strong and then they have a pullback is watch volatility. Volatility is going to give you an indication, are the markets fearful of this big move lower or this move lower? In this case, we didn't even move 1% down, and it seems like a crater hole because we just haven't had a big move in quite some time, right? I mean, just it has not happened. But go look at volatility. When you look at volatility, then what you're going to see is, well, gee, are the markets really fearful or are they not fearful? Okay. And if you don't get a big bump in volatility, then that would be enough to tell you that markets just don't view this as anything of importance, right? They just don't view it as important. Okay. It's not something that the markets are even thinking about. Now, this past week, as I told you, the VIX closed the week out at 1456. So let me just switch the screen over here. I'm still having some issues with it, but let me just get a screen view here of the VIX. Let me just move the screen over here like this. So let's get the VIX up here so you can see something. You can see we actually moved into the yellow zone, but then we flip back over and we're back into the green again. Okay, even with that big move lower. I mean, the SPX moved lower by 30 points, but we're still in a contango environment. It's not that serious. I don't see anything that bad, right? So at least yet, if we get more momentum down and we get some bad earnings coming out this week, because we're going to have Amazon, I believe, coming out. We're going to have Facebook coming out. We got some key earnings from oil companies, Chevron, Exxon on Friday. We've got some key data coming out on consumer spending with Visa, PayPal, MasterCard for consumer spending. We got Microsoft earnings coming out. On top of that, we got the FOMC coming out with they're not going to change interest rates, but everybody's going to hear what Boom Powell has to say at his press conference at 2:30 p.m. Eastern time on Wednesday. So we've got a lot of data, a lot of economic data. We got first pass of GDP coming in for coming in for Q4 or final. We get the final on that. So it's just there's a lot of information coming out to the markets. But right now the volatility is just everything is fine, and the markets just are not that enamored with volatility at this point in time. Okay, so that's a little bit about what I'm seeing here, and I'm going to leave it on the 240-minute chart. Apparently, that seems to be refreshing quicker than others. If we look at the bond market, bonds was up almost one full handle. All right, and you can see here on this chart with the bond market up. Let me just try a daily, see if I can paint it, but maybe not. Everything is just really slow. It doesn't seem to be painting the daily right now. But you can see the bond market moving up strongly. And then look at interest rates. If we look at the 10-year interest rate, okay, 10-year interest rate, we've come below the upsloping channel here on the rates. You can see if I just kind of move it down a little bit, you can see just like this is the upsloping channel, and we broke that channel back here on 21st January. We've come right down and hit my support point, 1668 roughly, and then we bounced around that. If we break that, keep in mind, if we go below that, I believe you're going to start to see equities act adversely to lower interest rates. There is a low interest rate level of which equities like. But when you go below a certain level, that means to say, or the interpretation is, big money's going to interpret that as the bond markets are fearful of the next 8 to 9 months in the economy. So risk off is the watchword, and you're going to see some more equity selling. So this is going to be key for next week. We got to watch the interest rates. Now, the other thing that really had an ugly time, just coming down and taking a look at it, is let's go to oil real quick. Oil is down dramatically for the year. Look at this. This is a 240-minute chart. And you can see oil broke the upsloping trend line that I had on oil, right? There's the upsloping trend line right here. You can see how it fit very nicely. And when we just went south below, we never went below the prior pivot low when we did break the line. But here we broke this line, and we've also broken the prior pivot low, which is sitting right there, right? So I can just put the cursor in there in your market on the chart. You can see here, and now we're back down to 54.20. Now all of 2020 I kept saying oil is going to dance around $55 a barrel. It's going to run up, it's going to run down, and it's just going to be like a bug to a bug zapper around the 55 level. This big move up here was just in reaction to a lot of the initial Saudi production cuts via OPEC and the strong belief of very strong global growth in 2020. If that is emancipated, castrated, so to speak, and 2020 comes in weaker, then we're going to see oil chop around in the low 50s, maybe even the high 40s. Okay. So that's kind of what I'm seeing there. And if we come over and we look at nat gas, it's 1.886. Look at this. We are down at lows that we haven't seen in quite some time. Okay. Really an ugly and I tried to come in here and just do on a bull put spread here on these lows here, and it just kind of flushed me right out of it. So I just took a small loss. I got out thinking that nat gas would at least come up to a value area here around or a little bit over 2, but it never did do that. So There's just a tremendous amount and abundance of nat gas in the markets, and there's still, at this point here, I think bull put spreads would be worth another bet. Okay, but I would wait for a signal to get a trigger on that. But with a warmer summer season in front of us, that's kind of what we're seeing right now and what I'm seeing right now. And then, of course, if we look at gold, gold had an up day on Friday, but I still believe, and this is a 240-minute chart, the 2019 high of gold 1613. I think it's going to have a difficult time moving up much higher than this. It may poke its head up, but I think there's just going to be a lot of competition for money. And depending on if we get more in a risk off, you may see a little bit of a move higher in gold. The one that really interests me is palladium. Palladium, it just keeps making these all-time highs. I mean, it's a rocket ship. Um, and I believe that palladium, the backside of this move here is going to be very ugly. I would like to see a little bit of a divergence here in some of the indicators. I mean, the upward vector of the 50 EMA and the 200 EMA is more like a biotech stock. It's crazy. I do believe it's going to pull back a little bit, consolidate, make another run higher, and that second run higher is going to be on weaker volume. It's not going to be able to make it back up, and that will be a good shorting opportunity. There's other opportunities in the ag market. Members, I'll talk to you about it this Sunday. If you're not a member of our group, I highly encourage you to come in and check us out. Otherwise, everybody have a great weekend, and I will see you for our weekly market watch next weekend. Hopefully my daily is working okay on eSignal at that point. Take care, everybody. Ciao now.